Hello everyone. In this chapter, we will discuss the efficient market hypothesis, evidence associated with the three levels of market efficiency hypothesis, market anomalies against efficient market hypothesis, and some behavioral finance issues. The efficient market hypothesis states that all securities are priced correctly. More specifically, stock prices quickly and fully reflect all available information. Stock prices offer expected return consistent with risk level. Stock prices reflect all past information. Market efficiency is about informational efficiency, not the operational efficiency. This graph compares market efficiency with market inefficiency. The solid line shows that stock price jumped at the market opening to reflect the arriving good news. The dashed line showing that the stock prices react to good news gradually after market opens. The solid line represents the case for market efficiency, and the dashed line shows the case for market inefficiency. If the market is efficient, then it would take no seconds for the stock price to incorporate arriving good news. The implication is that market efficiency leaves investors no chance to make profits by trading on arriving news. Market efficiency relies on several conditions, such as rational and profit-maximizing investors, no market anomaly in stock prices, costless information, and prompt reaction of investors to new information. Are these assumptions realistic in today's real stock markets? Probably not. Assuming the market is efficient, but to what extent do securities market quickly and fully reflect different available information? There are three levels of market efficiency: weak form, semi-strong form, and a strong form. The weak form efficiency hypothesis states that stock prices have incorporated all market level historical data. The semi-strong form efficient market hypothesis states that all public information are incorporated in stock prices, and the strong form efficient market hypothesis states that even non-public information are already reflected in stock prices. The weak form market efficiency hypothesis states that stock prices reflect all past price and volume information. Therefore, the stock price chart that contains the history of price and volume information is of no use in predicting stock price changes. The weak form efficiency market hypothesis is a bad news to technical analysis, which relies on past history of prices. Under the weak form efficiency hypothesis, technical analysis is of no use in forecasting stock prices. The semi-strong form market efficiency hypothesis states that the market is more informative. Stock prices reflect not only history of price and volume information, but also all publicly available information. In this case, stock prices are much smarter than most people think. The semi-strong form efficiency hypothesis is a sad news to those who devote to fundamental analysis in stock investing, because fundamental analysis relies on public information about economy, industry, and companies, which are of no value in forecasting futures changes in stock prices. There is no way for investors to beat the market based on fundamental analysis. The strong form market efficiency hypothesis states that even non-public information, such as insider information, has been incorporated in the stock prices, and that insider trading is of no value to investors. Well, if the market is truly efficient, then what investors can do for their investment? The answer is passive investing. Is the U.S. stock market weakly efficient, or semi-strongly efficient, or strongly efficient? In the past, financial researchers conducted many empirical tests trying to reveal the truth. To test weak form efficiency, we look at the randomness of stock price changes. The consensus so far is that stock price move randomly, and it's likely the market is at least weakly efficient. To test the semi-strong form efficiency hypothesis, we use event study approach to examine the stock price behavior surrounding certain corporate events, such as earnings releases. The consensus is that the U.S. market is a little short of being semi-strongly efficient. To test the strong form efficiency hypothesis, we look at corporate insider trading who have exclusive access to insider information, and to examine if their trading are profitable. Due to the strict regulations on insider trading in the U.S., there is no evidence shows that U.S. market is strongly efficient. So empirically, U.S. stock market efficiency is something between weakly efficient and semi-strongly efficient. You may be convinced that the stock market is efficient at this point, but empirical evidence on this issue of market efficiency is truly mixed. There are many so-called market anomalies showing that the market may not be that efficient in the real world. For example, the post-earnings announcement stock price drift anomaly shows that the market is not fully efficient in incorporating news containing earnings announcements. Other anomalies include the value firm effect, small firm effect, and the January effect. Value line ranking system demonstrates another market anomaly for efficient market hypothesis. The profits generated by data mining based trading is another case. One possible explanation for the market anomaly is that investors who participate in the stock markets are not rational creatures. Human beings' behavioral bias can often explain those so-called market anomalies. Often, biased investor behavior leads the stock price deviate from its intrinsic value. In summary, the stock market seems to be efficient, yet empirical evidence are mixed. It's safe to say that the market is generally efficient, but not always. This is the Kevin Zhao. I hope you enjoyed this video, and I'll see you in the next class.